So hello and welcome to Conversations with Esther. Today, I hope you can hear me. Bwana Matthew, you can hear me, right? Oh, good, good. So we begin with a word of prayer, as always. Father, we thank you for this session. We pray that you will go before us and that what we will learn will transform our lives in Jesus' name. Amen. So our guest is in the house. And before that, I want to put up something here briefly, just for as an intro. I hope you can see my screen so that we can quickly just go into what we have for the day. Allow me to pull this down here. Good. Welcome to Conversations with Esther. Conversations with Esther is an impact-driven professional platform that informs, educates, and rebuilds mindsets to ignite ethical and authentic leadership, best practice within industries while promoting healthy workplace relationships. Conversations with Esther equips the employee with relevant workplace skills while supporting employers to attract, develop, motivate, and retain talent. Guided by our three values, integrity, excellence, and impact, Conversations with Esther envisions a world transformed by candid conversations, respectable relationships, and intentional leadership. Now, our theme for 2024 is prioritizing holistic wellness, and hence the topic for today. January, we went through physical wellness. February was our mental wellness month, and we are in March, which is, if you look at the pillar here, we are in March, which is our financial wellness month. Next month, we move into social. The following month, we move into spiritual wellness, environmental, intellectual, and we'll be done with our 7 pillars of wellness. Now, it has been proven that organizations that prioritize holistic wellness stand to benefit greatly, recording improved employee productivity, reduced healthcare costs, reduced absenteeism, reduced presenteeism, improved employee overall health, reduced stress and burnout, improved financial wellness, increased job satisfaction resulting to talent attraction and retention, decrease in employee turnover, happier employees, among others. These are social media handles, and we want to appreciate you for supporting us on our YouTube. We actually hit the 1,000 subscribers mark. We encourage that you also subscribe to our YouTube and watch our previous conversations. We've had conversations on wellness, mental wellness, workplace issues, and many others. That's my LinkedIn, Esther Katiba, Instagram, Conversations with Esther, and you can drop us an email at info@conversationswithesther.org. So today, this is our topic. We have the financial doctor in the room, and I don't think I need to introduce him much. Minding my money. And I like that because it keeps reminding me that we need to mind your money. When you're spending your money, when you're investing your money, mind your money. Risk is an important consideration when you choose where and when to invest. It is important to know how much risk you're comfortable with as you choose your preferred investment vehicles. If you focus only on achieving the highest possible return, you may not recognize the risk you are taking. So, which are the best places to invest, and what red flags should we look out for as investors? Allow me to welcome the financial doctor, Mr. Alfred Matthew. Alfred is seasoned. He will tell us more about HISA. He will tell us about investments. He is the best that we can have on this topic. Karibu sana, Mr. Alfred. Karibu.
Many thank you. Thank you so much, Esther, and our listeners this evening. I'm indeed privileged to be in your midst this hour as a financial doctor to walk you guys through important insights on financial planning that will help you to make best decisions on the type of investments that exist out there in the market and what will be the probable risks that you perhaps go through as you navigate this journey and how you can manage. As Esther has just introduced me, my name is Alfred Matthew, and I'm a financial doctor. I lead an insurance agency by the name HISA Africa Insurance Agency. HISA Africa Insurance Agency is an intermediary of two customer-centric giants, the Absa Life and the Old Mutual Life Assurance Company. HISA has been in operation now the last, I would say the last 10 years or just about 11 years. And my journey in this career started off when I got my first job with Old Mutual right after campus. Old Mutual was good enough to come my way and give me a chance to become a financial advisor, and which I did and excelled. And over the years, went through the various sales ranks to the highest level, that was the GM of South African Old Mutual East African business, a position that I reached in 2018 and decided to focus on my sales career. Presently, I'm offering my services on behalf of these two organizations, the Old Mutual Life Assurance Company and the Absa Life Assurance Company. Old Mutual has actually had the longest, have had my longest stint there. Absa Life has been a journey of about 5 years. With these two organizations, you expect that your financial needs are met at end. One of the things I want to tell you, my listeners, this evening, is that financial matters are the matters that when we were young, our parents never really gave us an opportunity to engage with them on money matters. We thought that was a privilege for parents, that was a privilege for the rich, that was a privilege for the landed, it was a privilege that was not meant for everyone. But what we see here today is that either due to lack of knowledge, lack of awareness, some of the people that have gone through the entire academic training have actually not excelled in their financial matters. And there has actually been a gap when it comes to financial planning. A lot of people that are academically polished, they have actually not been able to polish up on their financial matters. So this evening, I'm hoping that the engagement that you're going to have, courtesy of Esther, is going to elicit new engagements with new people, and it's going to give you a fresh, review of what you are doing with your money, so that you can try to become better in money management. Let me start off by saying that every one of us has got goals. These goals may be the short-term goals, they may be the medium-term goals, they may be the long-term goals. I think the whole idea of planning is very, very, very key. It is not the money that you're making today that is going to make it easier for you to achieve goals. The fact that out of the money that you make, you come up with goals and you plan how to manage your money and leave a portion of your money to be able to deal with these goals, that ultimately is what is going to help you in navigate through this particular journey of financial planning. The ability to manage your money in order to achieve your short-term, medium, and long-term goals is what makes a financial plan. So when you think about the financial, the short-term goals, you think about the emergencies. If there was a financial disruption today, and you need money in the next 12 hours, where would you get this money from? For a lot of people, resort to borrowing from friends, resort to borrowing from relatives. Some people resort to shirking. There are many things that happen. But I think a prudent investor would ideally come up with a strategic way of handling the emergencies. And the emergency fund should be an equivalent of 3 to 6 times of your monthly expenses. This is money that you can unlock or you can access anytime without a long process. Then the moment you need money, you can actually go to a digital platform and access your funds wherever they are and be able to meet the obligation. We've got an excellent platform there that's called the Money Market, and I'll be talking about this a little later. But in the Money Market, there is all the flexibility. Whether you want to top up your account, whether you want to withdraw your amount, what happens is that the money that has been locked in this short-term fund, the Money Market for that matter, this is invested in what we call the government instruments, the treasury bills, and the treasury bonds. And when that money is locked there, it earns interest on a daily basis. And this is what we call the daily yield. At the point that you want to withdraw your money, you get your principal plus the interest that has been earned or accumulated over the period. You may wish to be in the money market for as short as 1 month. You can go as long as you wish. But I think the most important thing is looking at security, you're looking at accessibility, you're looking at certainty. These are some of the factors. And of course, what I think, you also want to consider the issue of the risk. That this is the particular investment platform, there is minimal investment risk. As I said, since most of the money is is invested through the government instruments. The only risk that we have got in this particular instrument is if the government system or economy corrupts entirely. We have no experience how an economy corrupts. We've never gotten there. The economy may be struggling, but we realize that as a Kenyan government, ever since we got independence, the government has never substantially, failed on honoring its obligation on the short-term instruments, because it's a very, very key instrument through which the government raises money for the various investment agendas. So this is the recommended path. Then we got the medium term. Most of us have got children. Some of us might be married, others might not be married. When you think about yourself and you think about those that are depending on you, and especially now we look at these children, looking at the academic requirements of children, the financial obligations that come with it. You want to educate your children maybe in the next 5 years, in the next 6 years, in the next 20 years. Where is this money going to come from? This is money that we start building into a portfolio in the medium term space. And for a lot of people, you either do this contractually or non-contractually. So what is a contractual investment? It is where you decide, me as Esther Katiba, the next 10 years, I want to accumulate a fund that will educate my child or my son or daughter in the environment. I want to be putting aside 10,000 shillings, 30,000 shillings, 50,000 shillings, 100,000 shillings, depending on the goal that you have for that child. If you have intentions to give your child maybe education outside of this country, your goal may stretch a little more, so you may have to put aside quite some cash. If your intentions are local, then again, that will be aligned. But let me say something. There are people who have gone through this life, they have earned all the money again because they were not very cognizant of the planning aspects around the medium-term goals. You end up remaining a tenant for the rest of your life, because if you have to, jump out of being a tenant, the only option is either to buy a house or build one. How do you buy or build a house? It is by putting a portfolio that is geared towards buying or building that house. And this is a journey normally. It will be a journey of maybe 5 years, 10 years, 20 years, depending on your current income pattern. So when you look at medium term, we're looking at anything 5 to 10 years. And here we're looking at how to educate our children, how to buy houses, how to build houses, how to secure funds that can actually take their children for their masters out of the country, how to take your family to a good international holiday. Those are kind of considerations. And then normally I recommend to people that between 10 and 15% of the monthly income should be directed towards a medium-term investment. When you go non-contractual way, it means to be investing as and when. Even with a medium-term obligation, you may decide I don't want to go into a structured investment where a certain amount is allocated on a monthly basis or yearly basis. I need to say that every month, maybe the month that remains after I meet all my obligations, I'll throw it into a medium-term investment. So that is what we call a non-contractual investment. Let me talk about the long-term one. And here this is where people talk about retirement investment. We talk about succession planning. And we have a problem in our country. There's too much cry and pain at old age. For a lot of people, it just happened too fast. I must tell you today that there is no future in the past. If you are really planning how to one day retire, realize that your retirement journey began the day you started working. For a lot of people, when you hear retirement, they think it's a conversation when you are 50. They think it's a conversation meant for 60. They think it's a conversation meant for 55. If you really love yourself and care about financial independence at old age, we should see that in the way you are dealing with your money matters. If you're just a spender, a person who is spending majorly on lifestyle, majorly spending on things that give you instant gratification, and you're doing this at the expense of what is going to take care of your long-term goals, then be sure when the time comes, they'll be paid. A lot of people, and as you see in the next slide, they're not able to meet their medical obligations because, they never planned. For you to succeed in your financial planning journey, financial intelligence is needed. When you see people succeeding financially at old age and midlife, it is because planning has actually taken place. You've got to ask yourself, what are some of the most common regrets of guys that have retired? I know from time to time you interact with guys that have retired. Some have already achieved the investment agenda, others have not. But when you listen to the voices down there, what are the most common regrets of the people that have retired? This is our journey. And I must tell you what, this journey for some of us, the other day that you are born, you've gone through the foundation phase. Now, some of us are in the right planning phase, and some like myself are now getting into the old age. One of the things that I must tell you here about planning is that the trouble with the future is that it comes too fast. The trouble with the future is that it comes just too fast. It was the other day that I was in high school. It was the other day I remember in university. I've now worked for 27 years. That is at the age of 52. My retirement is exactly 96 months away. Call it 8 years. There's not much time left for me to write my narrative. I have perhaps lived longer than I'm likely to live from now on. So whatever that I'm doing in my money right now counts. But I must tell you that for those that started doing their financial planning early, the old age comes smoothly and there's less pain. Of course, we know that at old age or at whatever point that God will call us home, we will die. But the question is, financially, did we all live? A lot of the people that are dying didn't necessarily live. They just found themselves there. Start ensuring that whatever you do with your money, the small steps, do them right. There are enough risks on our path. And I just want to highlight some of the risks that may come your way, may come my way. And none of this is what we call the market risk. So what is the market risk? This is why the market forces decline the value of your investment. I want to look at what experience the country went through and even globally went through with the COVID. So many people who are not very, very careful on the issue of financial planning and who majorly build their portfolios in solid manner. Building your solid means, for example, going to solid assets, plots. Kenyan people are majorly known for plots. You're buying plots everywhere you go. So there are enough people who got severely affected by COVID. When this happened, the disruption came and you're not able to convert their solid assets into liquid. Now, so many people are trying to offload their solid assets at the same time. So what happened? Assets that had for the longest time been on upward trajectory. For the very first time, we saw the value of plots coming down. That you did a valuation of your asset one day and you're told that your plot is worth 2 million. But when you sell it and put it to the market for sale, no one is offering the 2 million. No one is even offering 1.7 million. You're forced because of the situation in the country to sell it at what they would call a throwaway price of 1.5, 1.4. So there are instances where the market risk influences the downward trend of some of the asset instruments. The other one, let's think about the credit risk. And I'm talking about this in this particular journey because all of us are in different phases of our life. And we've got to start looking at how some of these risks affect us and how we can mitigate. So credit risk. You remember, a lot of people have always resorted to borrowing from banks. And you borrow from banks to be able to meet some of your medium-term and long-term investment agenda. You want to build a house, you want to buy one, you take an apartment, whatever, you buying some brand where you want your family to settle one day. So the credit risk that I'm talking about here is that your ability to pay back that amount could actually be affected by a number of factors, which may include your health. If your health circumstances change, your ability to pay off the obligation would also get affected. Let's think about the next one, liquidity. Liquidity risk. And this is instances where you're trying to offload an asset, but the market is not ready to buy. You don't have buyers of your assets. You tend to offload a plot. It could be a commercial plot. You're trying to offload it because need for cash has come up. But the market out there, due to the situation of liquidity or the economic situation of the country, people are not buying. Let me then also think about the operational risk for this particular stage. And what are operational risks? These are risks that are influenced by internal processes or systems that manage or guide your business. Let's look at what is happening right now with very high taxation rates coming up. The same salary, but you have to pay a bit more for you to, to align and to comply. I also want to think about inflation risk. The same money that you're earning remains, but the cost of living is going up by the day. This is what we call the inflation risk.
that the purchasing power of their salary is actually down because of the increased price of the commodities. How about the currency risk? Where the exchange rates, they go haywire, affecting the value of your investment. So many people have been affected by interest rate risks. I know for the longest time, banks, have been charging an interest of about 12, 13% up to 15 on borrowing. But with the exchange rates that have recently gone haywire, most of the banks have written to their customers that they are reviewing the interest rate that they are charging. And I'll tell you what, most of the banks now are in the space of 18, 19%. And that has got a direct impact on the things that you could possibly achieve on your financial plan. I also want to talk about the last one, which you can call the concentration risk. And concentration risk is now where investors that, for example, for you, all the money that you have had, you have directed it into one asset, call it maybe land. And then when the market forces change, the portfolio is significantly affected. I want to share with you a couple of statistics that shock me every day. Did you know that about 85% of Kenyans are spending more than they earn? And what does that mean? That clearly you know your income is $500,000, but you're spending 600,000. That clearly you know your income is 200,000, but your lifestyle demands 250,000. That your income is 100,000, but your current lifestyle demands 150,000. And the big question is, where are you getting the extra money? For a lot of people, you resort to borrowing. And this is now where the planning aspect comes in. Because as I think about some of the risks that investors go through, I think there's one clear risk of poor financial planning. Poor financial planning. That is why a lot of people are spending more than they earn. People who love themselves will never spend more than they earn. They will always spare a portion of their income to go into building reserves, to go into building security. Because your tomorrow matters as much as today. So when you're spending beyond the amount you make, the surplus will generally come from borrowing. And when you start carrying debts forward, that affects your financial stability. Because not everything that you're encountering in life is guaranteed. It's going to be certain. When we think about uncertain situations such as the disruption that went through the COVID, with the uncertain times, people that had heavy loads of debts and liabilities, they were more affected than those who didn't have liabilities. Those that had car loans, those that had circle loans, those that had bank loans, those that had mortgages, a lot of them, if some of these instruments were not secured through the proper way of being like financial planning, these people got more affected. So the big question to all of us is, where are you? Are you the type that are spending more than they are? Or are you spending everything that you make? So what's your current status? Because of the kind of spending that there is in our country, 90% of people get to the finish line without income. You retire it, but you have nothing that can sustain your retirement. So what do you do for survival? You start selling off most of your assets that were soaring. And by the time you are gone, you're leaving nothing for your children, you're leaving nothing for your grandchildren. Remember, it is God's wish that investors leave enough for their children and children's children. So when you deplete all your assets when you are alive, I don't think that was God's wish. That is your wish. If you didn't do proper financial planning, then it means that you actually live in your own world. 98% of people, because of the kind of spending that you have had historically, can't be able to meet their medical obligations. So you get into old age, and most of the medical obligations that come your way, you have to do a fundraising. Your children, you have to come together and fundraise. Your relatives will have to come together and fundraise. Everyone in the family knows that you are a liability. That every time they see you, they know you borrow. They know you have a problem. They know the financial burden is coming. So it is good that you can revisit our financial planning, ensure that even as you go about your day-to-day, you're putting aside a portion of your income to be able to offer that cushion. Otherwise, a great risk is coming. Statistics show that most of the retiring people have got all the time. That's why they are idling around. What they lack is money. And in our country, we talk about the dependent syndrome. The youthful investors, on the other hand, have got all the time until the relevant of it. You come across young people who tell you every time that, me, I'm still only 30 years. I'm only that 5 years. Me, I'm only 28 years. Me, I'm only 40 years. They still keep feeling young until the current employers can no longer have them in employment because they are too old to work. Because as you age, there's other circumstances come in which you're not able to control. And one of them could be your health. Of course, employers know too well that beyond age 60, you're not economically productive. That is why you are repressed. That's why people ask to go home and retire. So you may be calling yourself a young person, beautiful person, but realize that there are some of the circumstances that are not in your control. And time will come when you're going to be shown the door. So why don't you use your today to build the cushion for your tomorrow? Because some very, very scary statistics around our retirement, which has actually been at an average of 60 years. And one of the things that I see is that about 50% of those that have retired have already sunk into debt. Some of the people, by the way, even as a way to be paid their pension, they start borrowing against it. And they borrow from friends, they borrow from relatives, they even promise the SACCOs and Shyrock to pay back. So they advance some cash for survival. By the time the actual pension money is released, you've actually already spent a substantial part of that money. And within no time, you have joined the statistics of the poor one. It's a very, very scary thing. Very, very, very scary. A lot of people don't want to plan. And when they plan, the priorities are wants, not needs. About 45% of retirees have nothing to do after retirement. They become idlers. They only, improve the idler statistics. Have you ever sat and thought about what you are going to be doing the day you're going to retire? Let me tell you what, if you're 40 years now and going to retire at 60, you've got 240 months left. You've got 240 salaries left. If you're 50 years now and going to retire at 60, you've got 120 salaries left. If you're 30 years and going to retire at 60, you've got approximately 360 salaries left. Have you thought about at the end of this life, and when your professional journey comes to an end, what are you going to be doing? A lot of people don't even think about it. So you are there, you're retired, you have nothing to do, you just become an idler. But 5% of retirees deplete their investments for pension or their pension investments, but they're still in good health. That's 5%. So imagine you now at 70, and the pension that you are paid has already been depleted. So what you're doing is that you start depending on your children, you start depending on relatives, you start depending on external support. 65% of retirees are very heavily sorry. And what I mean by this is that too many of Kenyans are buying plots. I think it's the only thing that our parents told us, that the only mark of your success when you get to Nairobi, when you get to other counties in this country, the only way that you could prove that you're doing well is buying a plot. And the big question you have to ask yourself, when you need cash, how quickly would you be able to sell off that plot? If there was an emergency, would buyers come your way quick enough that you actually be able to attend to the emergency? Many retirees, as you have seen, are pursuing their physical fitness at the expense of financial. What I mean by this is that so many of the retirees that I even see today, you see them go to the gym, you always get them in the field doing their jogging, they are walking, they are swimming, they are doing all manner of physical exercises. But unless you also align your financial fitness, you will have a very miserable life where you'll be very physically fit, but very broke. Because you've enhanced your physical fitness, you like it to live longer. But can you imagine living longer, but very broke and very poor? Retirement, for that matter, is not always about age. Retirement can as well be influenced by change of medical circumstances. You imagine of a situation where somebody has been diagnosed with a heart problem, somebody has been diagnosed with a kidney problem, somebody has been diagnosed with cancer. Your productivity is going to be severely affected immediately after. And then what happens is that chances are high that your employer or even the business you do will send you on early retirement. So retirement is not always about 60 or 55. There are enough instances we see young people retiring only because their health circumstances change for worse. And finally, by definition, retirement is not the age that you're going to retire, but the age you're going to give your money space to work for you. One of the things we want to agree here, which is common for almost everyone, is that we're working very, very hard to build our liquid security base or money base or financial base. And for the better part of your life, when you wake up, you think about how can I make more? How can you put more into investment? How can you buy more land? How can you put more into a fixed deposit? How about your money market? How can I put more? That's a good thing. But you know what? There will also come a time when you not have as much energy to do what you normally do every day. And that is the time when your money will actually now come in and cushion you from going down. The money will come and start working for you. You have been working for the money for the longest time. Now you give that money space to start working for you. If there's nothing to take home, I think this is the most important slide that I want you guys to think about. There are three things that you got to consider when it comes to your financial planning. And one of these things is the energy level. The other one is the income, and the final one is the expenses. Let me talk briefly about the energy levels. Every person who hits will actually hit their peak of energy at some point in life. You agree with me that when you are a younger person, 25 years, 22 years, 21 years, you had so much energy in whatever that you did. You could even have gone overboard. You could have done even beyond the normal working hours. But as you start getting to the ages of 50, 55, 60, you hit your peak and your energy level starts coming down. Now, when your energy level starts coming down, it is important to realize that your energy level has a direct impact to your productivity. So as your energy level starts coming down, the productivity also starts coming down. You used to work for 8 hours. Now you can only withstand 5 hours. You used to open your business as early as 5. Now you're opening it at 7 because you're avoiding pneumonia. You know your eyesight is getting affected, so you have to drive home early. You used to go home late at 7, 8, 9. Now you can no longer drive late in the night. You are forced to go home at 5. So the moment your productivity starts coming down, the productivity starts coming down, the potential income that you can make also starts getting affected. Now, let me tell you what, for people that have done savings and investments when they were young, when your energy level starts coming down, the savings that you did when you are young, the investments that you did when you are young, that is what cushions you. That is what enables you to keep your head above the water. But if you never save, you never invest, when your energy level starts coming down, you will sink so fast. You'll be forgotten so fast. You'll be a liability so fast. So the encouragement when it comes to energy, now that you've got the right energy levels, can you maximize on the investments and savings? So that when the time comes when the energy levels are coming down, you'll be well cushioned by the savings and investments that you did when you were. For income, let me say what? No one ever rejoices of their growth of income. You always hear income is growing, but in a very sluggish way. That last year you used to have 100, now you're at 120. But then you look at the inflation is actually eating the potential growth of your income. Now, where your income is growing sluggishly, you realize the other side, the expenses are also growing. And for most of the people, expenses grow at an increasing rate. You need housing, you need travel expenses, you need to sustain your hobbies, you need entertainment, you got debts to pay, you got taxes to pay, there is inflation. So the expenses are generally going up. For some of the people, when you have a child and you get the second child, the expenses again go up. Before you get married, you can actually live in a one-bedroom house. You can stay in a bed sitter. The moment you get married, now with a spouse, you need a bigger house. So you now have to spend a bit more on on accommodation. When you get the first child, you realize now again the budget even goes up. So what I'm trying to say is that for a lot of people, the misalignment of these three items is what puts them into financial crisis. You've seen people selling off all their assets when they're in the stage of 50, 55, and maybe late 40s. And that's what for a lot of people call midlife crisis. So I want to tell you, my brothers and sisters today, if you really care about your tomorrow, become very, very deliberate on building your assets. The fact that everyone is going to spend this weekend or this holiday doesn't mean that you should join or you should also start spending. No. Look at your past very, very independently and be very, very purposeful when it comes to investment matters. And when investment chances, you have a chance, slim chances to invest or no chance. Please go for the slim chances. Don't say I'll not invest at all. It's also important for you to ask yourself, if I don't invest now, what will be the future cost of the delayed investment? How much will it ultimately cost me? I want to encourage you to start writing your narratives, and for you to get on this journey and succeed on it, I think the first point is to understand your money personality. And we basically got 4 money personalities. The first one is a spender, the other one is a dreamer, the other one is a saver, and finally we got investor. So who is a spender? These are guys that are majorly spending their money on lifestyle expenses. These are people who are focusing majorly on wants. These are people that would actually sell off their assets, just for comfort of today and tomorrow. A lot of these people are swiping their credit cards everywhere they go. A lot of these people are borrowing from every digital platform. They have got debts everywhere they go, even with their neighbors, their friends, and colleagues at work. The car, you have a car loan. The house is a mortgage. The property is a property. You're doing everything that you can do to get cash out of your assets, only for spending and entertaining yourself and your family in a particular lifestyle. The other person is a dreamer. These are guys that know their goals, but then the problem is that they are not doing the first step of saving. They are not doing the first step of investment. You keep talking about the goals, but you are doing nothing about putting funds together to help you to achieve those goals. The same, on the other hand, is this person that leaves some of the money in the bank account. They're not very deliberate on moving the money from a savings into an investment account. So, for example, you have a salary in a current account, but you move some of it into a savings account so that you can save it. If you leave money every year or every month in a savings account in the bank, in 1 year's time, what will be the potential gain in a savings account? Almost nothing. So why don't you channel that money into an investment account where you can start fighting inflation? The final person is an investor. They're very diversified. They understand their risk appetite, and they are long-term in the way they plan. I think this is where all of us want to be. But also remember one thing about investors, that they work with accountability partners. People who understand what you want to achieve in life, what is the budget, and within what timeline you want to achieve that particular goal. So the second point is look at your financial goals. Write them down. Look at the time left. Ensure that your goals are smart. The other point is that it's good to also look at your budget. And what is that budget? Is it expenses of one's nature, or are they needs that you're handling? How much income do you have? And what investments are you currently handling? Fourth stage, you've got to ensure that even as you embark on the investment journey, your portfolio remains diversified. And what is a diversified portfolio? It is a portfolio that takes care of your short-term needs, your medium-term needs, and your long-term needs. I think the greatest disaster that I see among investors is where a long-term investment instrument is liquidated to meet a short-term goal. Let me repeat that again. The greatest misaligned investors is where people offload a long-term investment to deal with a short-term need, which means the person is not adequately diversified in their portfolio. Let me tell you what, if you have got to achieve your investment agenda, ensure that your resources go into short-term, go into medium-term, and also go into long-term investment. This is the surest way for you to achieve your investment agenda. In the short-term space, you can always look at channeling 5% of your income into a money market portfolio. And as I said, you should be looking at 3 to 6 times of your monthly expenses as the baseline for the amount you need to have in the emergency kit. And then for the medium term, my recommendation always is between 10 and 50% of your income directed into building your medium term portfolio. Do it contractually, because it will come with discipline. Ensure that this money is allocated into an environment where it appreciates over time and accumulates higher than the inflation. Then finally, long term, we're looking about retirement, and ensure that 10% of your income is directed towards your retirement fund. I will talk about what we call the 50-30-20 rule. And the 50-30-20 rule means 50% of your income should be for handling your needs. 30% of your income is for handling your wants. But 20%, ladies and gentlemen, 20% is not for you. It is for your investment and savings. Whenever you make money, your resources can either be seed or bread. When you make money, there are 2 resources that you get. You can either get seed or you can have bread. So what is a bread? Bread comprises of the money that you need for the current needs. Whatever that you need for today, tomorrow, the day after, this month, those are your needs. And that is in the bread pot. But the seed is for your future needs. The retirement needs, your medium-term investment needs. The greatest challenge with a lot of people is that they eat both the seed and the bread. They eat what is meant for now, and they even eat what is meant for the future. So when the future comes, you have nothing to push on you, you have nothing to sustain you. Let me talk about the last one, and very, very, very importantly, this is what we call the wealth protection and distribution. So what is wealth protection? As you build your portfolio, it is important to realize that there are risks such as death, disability, physical illness, inflation. Ensure that your portfolio is well safeguarded. If you think about death, ensure there's a life cover, such that in the event of death of the person in question, there is a payout to the family so they can continue the investment journey. In case of disability of the person in question, again, there will be a disability benefit paid out to cushion the family from the financial disruptions that come with that. Then finally, ladies and gentlemen, I talk about distribution. So what is distribution? This life is not permanent. One day, all of us will be gone. Some people are busy preparing for their Easter celebration. They are busy preparing for Easter break. They are busy preparing where they're going to take their families. They are busy preparing how much they're going to spend. They're busy preparing where they're going to be on Saturday. They're busy preparing where they're going to spend their Friday. Busy preparing where they're going to be on Sunday, and even where they're going to be on Easter Monday. But the truth must be told. Some people, despite the plans and the preparations, are going to have all this in a mortuary. It can be me, it can be you. Death has no notice. Anyone can die anytime. We are always carrying our death wherever we're going. So even as you plan, it is good to ask yourself, what if I am not there? And how about those people that are depending on you? Because there's a big risk. If you don't do succession planning, it is one of the risks that I want to talk about tonight. Succession planning is so key because it gives direction on how your assets are going to be shared when you're not there. So as you think about the investment risks and the opportunities, it is good to also ask yourself, what if I don't live to see my grandchildren? What if I don't live the next 10 years? All the assets that you've accumulated, you need to have a mechanism that can allow distribution. You need to have a legally acceptable mechanism of succession. This is what we call the succession planning or distribution. Ladies and gentlemen, you can give yourself a challenge for this year, a challenge for this month, a challenge for this quarter, that you want to meet with your lawyer and write down your will. It's one of the big risks that I see in our country, that a lot of people are dying in testing. You never saw death coming. Now, upon death, people start fighting over the assets that you have built over the many years. So many of the businesses will not stand after death of the person that started them soon after his death. They will collapse. So why work so hard and not just do that last step of succession planning? It's a very, very big risk. Ladies and gentlemen, approximately 98% of Kenyans of age don't have wills. They have not seen the need to do succession planning. I'm inviting you tonight to have a date with your legal expert, your lawyer. Let them understand who you are from your asset perspective and who you are in terms of your abilities. You'll be asked some interesting questions, for example, because that is the reality. Imagine your lawyer asking, where would you like to be buried when you die? Why? Because if that is not handled, at the point of death, maybe your family will be saying Langata. Maybe your wife is going to be saying the family that. And only that could actually delay the body. Statistics show that about 117 bodies are rotting in Kenyan mortuaries because the family members are not able to agree. Please do not allow yourself to ever be part of these statistics. Do a succession plan. It's a big risk, but I think it is important that you can do it. So in terms of a professional financial planning, we've got 3 stages. And the first stage, as I said, is how to accumulate your wealth. You accumulate your wealth either contractually or non-contractually. Contractual avenue is where you decide, I want to be putting aside a portion of my income to go into building a portfolio in the next 5 years, the next 10 years, the next 12 years, the next 15 years. You're very, very deliberate. That I'm earning 500,000, 500,000, 20% of it is 100. So I want to dedicate 100,000 shillings into building a construction investment program that will then take care of the house that I'm going to buy or the house I'm going to build, the education of my children. Constructual arrangement. The non-constructual arrangement is where you decide you'll be putting the money as and when. You'll be putting the money aside as and when you get that money. The only problem with that is that without discipline, you might not be able to achieve the agenda. Let's talk about the second agenda. The second stage is what you call the growth and conservation. So what is growth and conservation? This is where you decide that the assets that I'm building, I'll have them secured, and I ensure that they're in an environment where they can appreciate over time. Very, very important. Growth and conservation. You ensure that the assets that you're putting together, they are assets that are going to appreciate. When you're going to buy RAD for speculation purposes, ensure you buy RAD in an environment where it's likely to appreciate over time. If you're putting your money in a money market account, ensure it's in a stable money market account where over time you're getting a very competitive return. If you're locking your money in what you can call a contractual investment program, you're looking for a deal that is competitive because different companies will offer different rates. And then for conservation, you ensure that the asset instruments that I'm investing in, they're adequately secured because they're enough risk on the way. This could be as a result of death, as a result of critical illness, could be because of stability, whatever it is. And then finally, I've talked about the distribution, and this is why we come up with acceptable mechanisms of distributing our wealth. To think about beneficial nomination, talk about estate planning, for people to talk about wills, the other fund. I think these are very, very important area that investors should consider. Ladies and gentlemen, this is a very important area. I know for a lot of us, when you started working, you were given some forms where you indicated your beneficiary in case of death. That is not enough. Today, if you indicated your beneficiary on your appointment letter or the appointment documents, and you die, your beneficiary is not likely to access your bank account. They'll have to go through the normal succession planning so they can the court can decide who ultimately will be able to inherit. So, ladies and gentlemen, let us consider this as a big risk in our country and see the need to do succession planning properly. Sit with your lawyer, do a will. I am not a prophet of doom, but with the little experience that I've got, and you guys will also be a witness, death is giving no one notice. No one knows the day, no one knows the month, no one knows what is going to be there for. The only thing you can do to this risk is to plan. If there are people betting on you, and especially your children, ensure that you don't throw them in the wilderness when you're not there. Ensure that there's a good cover, that in the event you're not there, there will be a substantial payout to your next of kin so that they can take care of your children. Some of the children have actually been left in situations that are very regrettable. That upon death of the parent, a child that was in a good high school dropped. A child that was in a good university dropped. A child that had just joined a nice primary school dropped. It is important that you can plan. But when you're not there, I mean, your people are taken care of. Think about disability. You are who you are because of your good health, but you've got no guarantee. You may be the best driver of the road. You may be driving the best car on the road. But how about the other people that you're meeting? Some of the people are deliberately driving cars that are not properly serviced, and they could easily cause accidents. Some of the people that are on wheelchair today, they're not on wheelchair because they made any mistake. Somebody else may have made the mistake. It can be anyone. So it is important that you cannot position yourself in case of disability case. It's a big risk. Think about critical illness. People that are going to hospitals for medical checkup. Current statistics show that adults, out of every 10 people that go for checkup, there will be one that has got a terminal illness. The terminal illness could be cancer, it could be blindness, it could be paraplegia, it could be kidney failure, it could be heart problem, whatever it is. But one person out of 10 has a terminal illness. So if you're that one person, how would that affect your financial landscape? How would it affect the people that are depending on you? Kenyans are planning for all the goals, but they're not planning for some of the risks. Think about send-offs. I have seen people selling off assets to pay the last expenses for someone, their loved ones. You can change the narrative. With only less than 10,000 shillings, you cannot be able to cover yourself, your loved ones, your spouses, for up to half a million shillings. That in the case of death, there will be half a million shillings to be paid out for this last rites. And it's very, very, very important. But the Kenyans who don't go the fundraising way, it is so painful and difficult to raise 500,000 shillings through a WhatsApp message. I use these 5 animals to demonstrate a couple of important financial lessons. And the first animal here is the lion. It's an amazing animal that takes charge of its environment. Imagine of a lion, a male mature lion, it can easily bring down a buffalo, which is approximately 30 times the size of a lion. And you ask yourself how. Now, from financial planning perspective, we all want to take charge of our money. Let us avoid being victims of circumstance. Let us be the ones calling the shot. Let us be the ones making the decision. You realize that all of us who are working and all of us that have spouses, your income goes to your bank account. It will never go to your spouse's account. If you're employed today, your employer will never pay your salary to your invest first, pay the balance. I want to talk about the next animal, which is the elephant. It's got an amazing memory. It is able to trace its steps. And this animal, even 10 years down the line, it can remember the path it followed to get the water and green the vegetation. We all need to have good sight of our expenses. We need to make good and very informed decisions. Kenyans have got a problem of memory. We forget our goals too fast. And because of that, I encourage you to write down the goals that you have for 2024. And even when you go to 2025, write down your goals. For a lot of people, you talk about the new Year resolution at the beginning of the new year, but soon after you forget them. Write down your goals. Then the other one, rhino. Rhino is an animal that confronts all the threats that come its way. All of us have got threats. Your threats could be peer pressure. It could be spending out the budget. Could be lifestyle demands. Whatever it is, deal with that threat. For you to be able to succeed financially, you got to deal with that threat. I've got the next animal, which is called the leopard. It's an amazing hunter. When it puts its eye on a gazelle, it will not accept any disruption. It will make every move diligently towards the gazelle. The next minute, it will bring down that gazelle, and it will not even eat it there. It will pull it to the highest point of the tree where it is safe from other carnivores. Final animal is the buffalo. Buffalo knows the importance of diversification. They walk in numbers. They graze in numbers. Because they know too well that the moment a buffalo is isolated from the rest of the herd, then it becomes a target by the carnivore. So this is preaching to us the gospel of diversifying our assets. Don't just put all your money into a solid asset. It's good that you can also consider the other asset classes that you actually be able to handle the other varied needs. I talked about the 4 money personalities, and for the spender, which is a big risk, you've got to review your lifestyle demands. Differentiate between your wants and your needs. For a lot of people, wants and needs are synonymous. Let me tell you today, your wants and needs have a very clear line that separates them. Start having a budget. Whatever you're spending your money on, come up with a budget and embark on savings and investment now. For the saver, and this again, I say that nobody leaves a portion of their money in the bank account. They are not deliberate on investment. For you, you have to grow by only retaining the money in the savings account or run it before the emergency purpose. The rest of the money, let it go into the investment platform. Diversify your investments so that you can grow the portfolio. The dreamers, guys, I say that every day they only talk about the big goals, but they're not investing. Stop procrastinating, take action. Manage your budget and create room for investment. Avoid giving excuses. So a lot of people that are in this category, they have so many excuses why they cannot take a good investment decision. They've got many reasons why they cannot take up a 5-year investment. They've got enough reasons why they cannot do a 10-year investment. They think it's too long. The final person, the investor, and that's the space that we want to play. For these guys, since they have done all that they need to do, it's good that you always ensure that your investment decisions are guided by risk appetite, and keep reviewing this and the emergency funding as regularly as possible, and ensure that your succession plan is updated all the time. So the big question today, Esther Katiba, who is eating Esther Katiba's money? Who is eating Marisina's money? I can see there is Anne Murray, there is Anne Minor, and there are many other participants tonight. There is Mercy, there is, all of us. The good question we need to ask ourselves, who is eating your money? I want to tell you what, there is inflation that is eating your money. An example here is given of a fund of 100,000 shillings kept under the mattress over a period of 20 years in an environment where the inflation rate was at 10%. You progressively lose the purchasing power of this money during the 20 years from 100,000 to 14,000 shillings. So if the money that you have today is not put in an investment program that is appreciating over time at a rate higher than the inflation, then you are as well losing its value. So this summarizes the you and I. And as I said, when people are young, there are many careless decisions that are made, very many mistakes that are made. There are two things to think about when it comes to how we manage our money. And the first thing that I want us to think about is time, and the other one is your money. Have you realized that there are, for a lot of people, there's too much time left at the expiry of money? Assuming that you are paid your salary on a monthly basis every 30 days, and the amount you are paid is so much. For a lot of people, there's too much time left at the expiry of the cash that you are paid last. The only thing that can get us financially stable is planning. Ensure that you keep away from long companies, because the bad choices that you keep making will have a consequence. Ensure that you work with a mentor. Stop procrastinating, because a lot of people, you think you've got all the time. Time is running out of our hands. And if you're not able to do your budget, be sure again, you're going to lose it at some stage. When you're a young person, your burdens are not as heavy. That is the time that you direct most of your money into investment and building the future. As you get into midlife, for a lot of people, now you have new obligations. You've gotten married, you've got a child, you've got a mortgage, you've got a car loan, you're buying a plot. So the debt rate is going up. So the savings that you did in the first stage come in and give you a cushion. But if that was done, you get old age with heavy debts, lots of liabilities, and you're not likely to enjoy your retirement. The financial basket, if you have to handle most of the risks coming your way, you've got to think about the emergency, and I talked about the money market. You've got to think about the medical insurance that takes care of your inpatient and outpatient in hospital. How would you handle an accident or disability situation if you got involved? And how about death? Think about life insurance. In case of death again, you think about last expense.
I think we lost Alfred. Let's give him maybe some seconds. I think it's an internet issue. As we finish, we're just about to close. We can keep our comments coming and questions. I think as he rejoins, I know he will rejoin shortly. We can keep the comments and the questions coming. Anne, Mureithi, and Mina, Clifford, Esther, Mercy, Mukami, Purity. We can give some comments. Yeah, I think he's back. Welcome back. I think we dropped. That's fine.
It's a poor side. Sorry about that.
Okay.
Sorry about that. So let me just go back to that slide. Sorry guys about that. So I was talking about the financial basket, and I was saying it has got products that all of us need to be able to handle the various risks on our way. And I talked about the critical illness. That's why for illnesses of terminal nature that we might experience, or loved ones might experience, you need a critical illness cover. For the contractual investment that you handle your medium-term obligations, such as educating your children, such as your own personal buying of assets, contractual investment and discipline will be needed. Budgeting will be very, 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 very key. Then retirement, I've talked about putting aside 10% of your income to be able to handle your old age retirement needs. If you're not doing it, there'll be a problem ahead. I've talked about money market, and I don't want to go again into it. I think the only thing I mentioned here is that in the money market, you can withdraw your money anytime you want, and whatever money you got in the portfolio will be earning interest. The present average money market rate is at 12.3%. Money is invested in treasury bills and the treasury bonds, and the interest is given on a daily basis, added to your capital every end of the month. I will talk about this briefly, but later, not immediately. But let me go to retirement investment. As I said, a lot of the young people think that retirement is so far. Your retirement journey started the day you started work. It is good that you can establish your current monthly expenses on average. Consider the time left. If you are 40 years and you want to retire at 60, you got 20 years left. If you are 50 and you retire at 55, you got 5 years left. If you are 30 years and retiring at 50, you got 20 years left. So establish the retirement age and the amount of time left. Come up with an instrument that will help to generate the income that you need for the purposes of retirement. And then the goal of retirement is to live off, and that is very important. Live off the assets and not live on the assets. We don't want to sell the house for survival, but we can earn income from the house to sustain our retirement. Ensure that your assets are well secured. You don't just have assets, but those assets are secured of the risks because they're enough risks. Is it too early to invest? An example has been given of 3 investors. One is a very wise investor. The other is not a very wise investor. And the final one is maybe a very late investor. And the first investor, at the age of that one, decided to put aside 100,000 shillings from their income over a period of 10 years. And the same was compounded at a rate of 10% through to the age of 60. So with a savings of 1 million shillings, the guy walked away with his retirement fund of 11 million. The second investor decided to start at the age of 41, but did it for 20 years, through to the age of 60 at a rate of 100,000 shillings. So for the entire period, he invested 2 million. Same compounded at a rate of 10%, he only had 6.3 million. The third and most rich investor started at 51, did an investment of 10 years at 100,000 shillings per year, 100,000 shillings per year. So he invested 1 million and only got 1.753 million shillings. If you can compare the first and the third, they both invested 1 million, but the outcomes were very different. The first guy took home 11 million. The second guy took home 1.7 million. The big question is, when is the right time to start investing? I'll tell you, ladies and gentlemen, you start investing as early as you can, because every delay has a cost. There's some parting shots when it comes to investments. In terms of adversity, you don't have an obstacle. You have a choice. We had COVID that we had all experienced. People only make choices on the way they spend their money. If there were disruptions coming again, how have you cushioned yourself? Obstacles are what we see when we take our eyes off the goal. When you stop investing, you don't want to invest, you're giving excuses, you only see obstacles. The other one, you cannot bring yourself to reality. You got to take action. What will it ultimately cost you if you don't take action now? Nothing great is created suddenly. It takes time, discipline, and focus. Take the small steps that you conquer the bad habits. The bad habits, especially on spending, you can only conquer them by taking decisions right now to do the small steps right. The formula that has been shared that helps investors to invest bigger is to think big, start small, but start now. The courage to begin is the same courage it takes to succeed. And this is what differentiates the dreamers from achievers. Ladies and gentlemen in the house, I want to say a big thank you. And as I take it back to Esther, and I think from the conversation that we've had this evening, it is important to realize that when it comes to financial planning matters, it's a personal responsibility. No one is going to invest on your behalf. You've got to take the first step yourself. And the time to do it was supposed to be yesterday. The next best time is today. Tomorrow is going to be late. If you're not investing, just know that people may not know today. You'll be on a very good lifestyle. You'll be driving the best of cars. You'll be living the most in the suburbs. But when the time comes, circumstances will shape you and take you back to the place where you belong. We saw with COVID, guys that lived in Runda were thrown out of Runda. They went back to Kitengela. So during a COVID time, guys that drove those Range Rovers, they were humbled back to Vitz and they started again. So depending on how you manage your money matters. You could be on the right path, you could as well be on the right wrong path. But it's important that you can have a direct engagement with the financial doctor so that I can do a financial wellness check to confirm if what you're doing with your money today is actually going to be sustainable and if it's going to take care of your future. I'll also be able to advise you what is the best way to handle your budget, the best way to handle your emergencies, the best way to handle your contractual obligations, and the best way and the best avenues to invest for return. We see that no one plans to fail. People only fail to plan. Once again, a big thank you to Esther for facilitating this. I think it's a very, very important engagement. As I wind up, let me say, one of the surprising things that I have witnessed lately is that there are many more women than men that are investing. Our country has got about 60% of investors are women, 40% are men. And when I ask why, I think we are, as a country, preparing for a revolution. Women are taking over this country only because of diligence, because they don't take risk, they do things at the right time. I think showing a challenge to the men that we've got to do what we need to do today so that you can secure tomorrow. We are the family heads, and I think it is important that you can do this and do it now. Once again, thank you so much, Esther. I'm taking it back to you. Asante sana.
Wow. Wow. I always want to listen to you. It's amazing. It's amazing. Thank you. And I see people asking for your contacts. Thank you. They are on the screen. And Bwana Matthew, I know we always give our people at least one session for free one-on-one, isn't it?
Yes, it's true.
So I'm trying to campaign for the people that are listening that they can get in touch with you and they will get one free session, one-on-one.
100%. Yeah,
Yes.
that's true.
Yes, so that we transform lives. And thank you, thank you. I want to look at the comments. I see Clifford saying great conversations, insightful and interactive webinar. And Mureithi says, wow, the webinar is so insightful. Yes, and we are live on our YouTube, Conversations with Esther Katiba. So you can always watch this later, share it with your friends and family. Let's spread the gospel and empower one another. Thank you very much. We have gone into 8:17, but it was worth it. And thank you, Bwana Matthew, for even stopping over on your journey just to make sure this conversation goes well. We always appreciate you. Always appreciate you. Thank you, everyone. God bless you and have a good night. Thank you and bye-bye.
Thank you very much. Good night.